Good afternoon, everyone. Hope you all are good. My name is Nitesh, and I'm a consultant trainer at Sankhyana Consultancy Service from the last 5 years. Okay, so let us talk about the Sankhyana first. So, Sankhyana is an IT firm which provide you the consulting, analytic, and training to the student and professional from the last 8 years. Okay, so today is the second day of our orientation session, and we will discuss about the how to mitigate the bank risk through the SAS analytic. We have already discussed one session yesterday. This is the second day now. So yesterday, those who have joined this session, right? We have already discussed about the what is SAS, what is the framework of SAS, right? And today we are going to discuss about the how SAS deliver a better risk management and how we can use the SAS in the banking industry and what are different type of risk when we are using the SAS in the banking industry. So that part also we are going to discuss today. After that, how do your SAS support your credit risk management? That part also we will discuss. After that, SAS fraud detection and what is the approach of the SAS. And in the last, if we will get the time, we will also discuss about the that one your you can say like that advantage of the SAS. Fine. Now, so, what is SAS? That part we had already discussed. What is the framework of the SAS, right? SAS provide you to access the data, manage the data, analyze the data, and present the data. So that part we had already discussed. Now coming to the how SAS delivered a better risk management. Okay, how does SAS provide you the better risk management? So here, the first that we are going to discuss about the regulatory risk management. So, as you know that the risk management in the bank has changed over the past 10 years, right? And the regulation that emerged from the global financial crisis and the fine that were lived it in the way triggered a wave of the change in the risk function. So here these include more detailed and demanding capital, leverage, liquidity, and the funding requirement as well as the higher standard for the risk reporting. The management of the non-financial risk become more important as the standard of the compliance and the conduct tightened. So stress testing emerged as a major supervisory tool in parallel with the risk or you can say the rise of expectation of the bank risk appetite statement. Okay, so bank also invested in strengthening their risk culture and involved their board more closely in the key risk decision. It also ensure your you can say like that efficient credit card analysis with the timely and accurate RWA reporting and regulatory capital optimization. It helps you to create a consolidated data, you can say modeling and reporting infrastructure for measuring and reporting on the credit and counterparty risk. Second, we have that is your capital planning. Okay, so what is capital planning? So capital planning is your foundation of the banking system to help to facilitate the economic growth and provide a buffer against the potential shock that may arise. Okay, so capital planning is an ongoing, dynamic, and forward-looking process that aligns the bank mission, goal, and the objective within the context of the risk. And it also incorporates the changes in the strategic focus, risk tolerance, business plan, and the other factor that help the board to identify the vulnerability concentration and manage the overall risk to capital the adequacy. Okay, so a capital policy is a written document that is agreed by the senior management of the bank, and it specifies the principle that management will follow in making the decision about how to deploy a bank capital. Fine. It also helps you to reduce the stress testing cycle time so that you can focus on the higher value activity, and it helps you to uncover the opportunity and the risk with the powerful tool and reporting capability that expedite the capital planning and it can go beyond your supervisory stress testing to anticipate the path ahead and prepare for the unexpected. It also helps to improve the transparency, audibility with the flexible workflow automation and embedded control. And it introduce a new model, methodology, and the scenario as needed. Now, the third, that is your uh, in this, right, when we are talking about the capital planning, right, so we have few more terms that is like how we are doing the capital planning, right? So it is going we are going to discuss about the identifying material risk. Okay, material risk. So, so first we identifying the material. So during this step, right, here the capital planning process, bankers should identify and evaluate the material quantifiable risk. Okay, and these include the credit, operational, interest rate, liquidity, and the price risk. Any one of these, right, risk in the isolation can lead to the capital deterioration, and the combination of any of these risks would expedite the capital erosion. So other risks, right, may need to be qualified, such as you can say the reputation and the strategic risk. And the bank should be keen to identify and report the projected increase in the risk categories. So early alert can prompt the management to take the action and ensure the proper capital level or manage the balance sheet to reduce the desirable exposure. Now, second, we have here your you can say planning and stress testing. Okay, planning and stress testing. Okay, so here the bank should prepare the strategic plan outlining action item in order to achieve the goal set by the board of the director, and the well-defined forecast for asset quality, asset liability, next equity multiplier, and the capital source and the usage would be the part of the plan. So common sources of the capital would include the retained earning, gain on asset sales, and an equity raise. So use of capital would include the dividend payment, losses on the asset sales, okay, net operating sales, right, and asset impairment and the regulatory deduction. So banks should, right, understand the impact from the changing interest rate and the economic environment on management plan and estimate how the capital is impacted from an increase in the loan loss reserve and the price volatility from the investment or from the mismatched asset liability cash flow. So here the growth in asset classes can lead to undesirable concentration that may be difficult to exit in a timely manner. And the new business line have large front cost that could impact the earning in the short run. So here the scenario analysis could be used to test and stress for the changes in the interest rate and the credit risk. The third we have here the you can say the conti- contingency planning. Okay, now so the here the bank capital plan should consider the contingency backup to maintain the proper capital adequacy, right? And the issuance of the common equity, preferred equity, and you can say the holding company debit or retained earning and the balance sheet size all are contingent source of the capital relief. However, the bank structure and the available resource will derive this process and its solution. For example, you can say like that the mutual may have the harder time to accessing the capital than a publicly traded commercial bank. So here the bank with the adequate capital contingency poses a higher risk of liquidity erosion. Okay, fine. The third, we have the uh, credit risk management. So what does it mean? What is the meaning of credit risk management? So it refers to your measuring and mitigating the risk of associated with the lent amount and being aware of the bank reserve to be used at any given time. So risk management involved the facilitating the proper decision making of the lender or the banking institution, and the economic stability of the nation highly depend upon the lending business, which become a link between the common people looking for the investment and the financial market, which run on the flow of the money. Okay, so here the ability of the lender to decide which loan application to approve or which application to be disapprove. Okay, play a major role in the credit risk management. Okay, so here the credit risk management involved examining a series of the steps to ensure the amount are lent to the reliable hand. Okay, so here the lender are expected to evaluate the loan application from the borrower, and they must ensure that the borrower can have the monthly payment in the future, and the lender must examine their current financial situation and their credit history and score. So it helps to build a trust toward the borrower and to understand whether they can be trusted with the money or not. So once the borrower are found creditworthiness, okay, the loan application get approved. On the other hand, if the applicant are found, okay, untrustworthy, right, the loan application get disapproved. So here the lender should have an eye for the detail to guess it right. So proper evaluation is must here. Fine. So they have to be a particular about the current financial status of the loan seeker, along with the being ready for the warning sign that their past credit record indicate to them. Okay. So here the evaluation is done concerning with the 5C of the credit. Okay. 5C. What are those 5C? Those 5C are, you can say, the character, right? Capacity. Third, we have the capital. Fourth, we have the condition. And the fifth, we have the collateral. Okay. Now, so while doing the evaluation, right, the person is totally concerned about this 5C, those who are doing the evaluation. So they look at the character, okay, what is the character of that person, what is the capacity, and what is the capital, what is the condition, and the collateral. So in case of assessment turn out to be wrong, right, here the possible trustworthy borrower turn into the defaulter. So it affects the financial stability of the lending institution, which play an important role in ensuring the economic financial stability. Now, the last we have the risk governance. Okay, what is the meaning of risk governance? So risk governance refer to the institution, rules, convention, and the process and mechanism by which the decision about the risk are taken and implemented. Okay, so it can be both normative and positive because it analyzes and formulates the risk management strategy to avoid and reduce the human and economic cost caused by the disaster. Okay, so risk governance goes beyond the traditional risk analysis to include the involvement and participation of the various stakeholders as well as the consideration of the broader legal, political, and economic and social context in which the risk is evaluated and managed. So here the scope of risk governance encompass the public health and the safety, and you can say, sorry, the environment, old and the new technology, security, finance, right? So sorry. So it helps to gain the holistic and enterprise view of your risk profile and internal control status. It also helps you to ensure the transparency and promote a consistent standard with the centralized model inventory and the model risk management framework. So risk governance risk governance produce accurate on-demand regulatory and management report based on the high-quality data. It also helps you to manage the critical operational risk and the compliance process with the self-documenting solution that ensure the auditability and the traceability of your management and regulator. So several independent group and the subgroup have been constituted to facilitate the independent evaluation, monitoring and reporting of the risk. So these groups function independently of the business group, and the risk management group is organized into the credit risk management group, market risk management group, operational risk management group, and information security group. So here the internal audit group, that is your third line of your defense, that provide you the independent assurance that the independent group monitoring the risk in the bank are operating in the line with the policies, okay, regulation and the internal standard that is defined by the management of the various risks in the bank. Okay, now coming to the SAS in the banking industry. So as you know that SAS, right, SAS is developed in the 1920, right? After that, for the agriculture purpose. Okay, so you know that in from 1926, right, SAS start developing the relationship with the bank and some of the insurance company, and at that time the 29% of the SaaS software revenue from the banking industry. So at that time, okay, approx in the 1920, right, SaaS was developed, okay, and it is launched into the market. So at that time, the sorry, why I'm okay, 29% of the revenue of your SaaS is coming from the banking industry and insurance industry. Now, after that, 90% of the right now, the 90% of the top global bank, okay, are the SaaS customer, and all the top global bank are using this SaaS software for the analysis purpose, okay, for the prediction purpose, okay. So they are using this. After that, 3,500 plus financial service and the customer worldwide. So right now there are approx 3,500, but more than that, okay, are the financial customer worldwide, and the 1,400 plus insurance customer in the more than 25 countries. Now, so what is your credit risk? Okay, so credit risk is the possibility of a loss that is resulting from a borrower failure to repay a loan or to meet a contractual obligation. Okay, you can also refer to the risk that a lender may not receive the owed principal and interest, which result in the interruption of the cash flow and increase the cost for the collection. So here the lender offer the mortgage, credit card, and other type of the loan, and there is a risk that the borrower may not repay the loan. Similarly, if the company offer a credit to a customer, okay, so there is a risk that the customer may not pay their invoice. And credit risk also describes the risk that a bond issuer may fail to make the payment when the requested, or that an insurance company will be unable to pay a claim. So credit risks are included based on the borrower overall ability to repay a loan according to its original item. So to access a credit card on a consumer loan, so lender look at the 5C, that is your, as we have discussed, that is credit history, capacity to repay, right? Capital, the loan condition, and the associated collateral, right? So imagine, right? You just imagine yourself at a car dealer looking at the car, and you always want that you always wanted. Okay, so here the car dealer is sitting just right there in front of you, fine, and the salesperson have just left to get the key so that you can have a test drive. So after your test drive, okay, you can you can find out that before you can even begin the process of purchasing the car company need to look at your credit to see if you are even qualified to make such purchase or not. So when what are they looking for at that time? So they are looking for your credit risk. Okay, so your credit risk is the possibility that you will not pay them the cost of your car in the full. So when you are making the big purchase such as your car, right, you will get a loan. So you will pay the loan back in the monthly installment for a number of years, and you may plan on making this payment on time each month. But not everybody is like us or you. So some people are not able to make this payment on time, right? So for those people, the credit risk is high. And if the credit risk is too high, so some company will not do the business with that person. Okay, so it is not just about the people that have the credit risk. Investments such as the bond also have a credit risk. Okay, so credit risk tells investor just how risky it is to get this bond, and here the higher the risk, higher the chance of losing the money on the investment, and the lower the risk, the lower is the chance of losing the money, and the higher the chance of getting the money. So when you get a loan, right, your credit risk is calculated, and who calculate the credit risk, and who, suppose I am talking about the credit score. Okay, credit score. So in India, right, we have one organization, right, that is CIBIL. Okay, so this CIBIL, that is company that decide the credit score of each and every individual. Okay, so mostly what happens, if your credit score is greater than 700, or you can say 720, okay, if your credit score is greater than 720, so most of the time bank will give you the loan. They will look to your credit score. Okay, okay, your credit score is good, then a bank will easily able to provide you the loan. So here the credit risk, right? Risk is important for both for us as well as the company also. Okay, so suppose you are about to do the business with, right, and having the low credit risk that allow you to do the business with so many more companies. So this include, right, this include having the access to the credit card. So having a high credit card limit to you only the few companies that are willing to take a risk and do the business with you. Okay, so company use the assessment of the credit risk to screen out the people that are least likely to pay them back. So most companies, right, will run their credit check, and if the credit risk is too high, right, then it will be denied. Then the service will be denied. Okay, and some apartment do this too also. Okay, so if your credit risk is not good enough, right, it means that your credit risk is too high, and then you will not able to get an apartment there. Now, so uh, so we have the different type of the risk. Okay, so but we should know what is risk. Suppose some of the company have the dedicated department only for accessing the credit risk of its current and potential customer, and due to the help of the technology, right, business can now analyze the data quickly and access the customer credit profile. Okay, so if an investor is evaluating to buy a bond, right, he will review the credit rating of the bond before purchase is made. So if the rating is low, right, then the issuer is considered to have a high credit risk, right? And if the credit, if it has the high rating, right, then it is considered to be a safe investment. Now, so let us see what are the different type of the risk. We have the credit default risk, concentration risk, and the country risk. So what is the meaning of credit default risk? So here the risk of loss which arises from the debater being unlikely to repay the amount in full, or when the debitor is more than 90 days past its due date of the credit payment. Okay, so it give the right to the credit default risk. Okay, and the credit default risk impact all the sensitive transactions which are based on the credit, like you can say the loan, derivative, and securities. And here the credit default is also checked by the bank before approving any credit card or personal loan. Now, second, we have the concentration risk. So this type of credit risk, which is associated with the exposure of any single or the group with the potential to reduce the large losses to threaten the core operation of the bank, and it may arise in the single form of the single name concentration, even the industry concentration also. So here the concentration risk is accepted within the multiple industries as the possibility of the loss due to a large dependence on the single vendor, geographic area, or investment portfolio. The third, we have the country risk. Okay, country risk. So here the risk which arises from the sovereign state, right, when it freezes the payment for the foreign currency, overnight default, or its obligation, which is termed as the sovereign risk. Okay, so here the country risk is exclusively associated with the performance of the microeconomic of the country, and it is also closely related to the political stability in the country. So sudden instability which tend to happen during the election, which result in the high country risk. So country risk refer to the economic, social, and the political condition and the event in the foreign country that may adversely affect a financial institution operation, and the bank must institute the adequate system and the control to manage the inherent risk of their international activity. Now, so how does SAS support a credit risk management? So first one is your automation of the complex risk management process, right? The third second, we have the powerful and scalable analytic capability. The third, we have customizable adaptable data and reporting, and the fourth, we have the powerful modeling environment. Okay, so let us talk about the first, automation of the complex risk management process. So here the automation in the risk management help the CFO and the finance leader to modernize the many aspects of the financial operation to improve the cash flow, boost efficiency, and promote the enterprise growth. So, as a leader are under the pressure to get the dispersed finance team working with the better speed, coordination, and the accuracy, where the automation helps to achieve a higher level of preparedness that will sustain their company through the disruptive event in the future. So here the CFO and the finance leader are increasingly implementing the digital technology and automation, and they see the value in ongoing digital transformation and the investment in the better tool to help them reduce the time spent on the manual finance process. Okay, so but when it comes to the credit and receivable, the large and the small company like face the prospect of the reduced cash flow and decelerating the growth if they fail to address the main risk factor that is lurking within their finance process. So here the automation in the risk management can help the finance leader and the finance leader meet those risks head on, especially within the credit to cash process. Okay, where rule based decisioning capability can enable the faster response timely when reserving the manual process for the expectation that is not routine matter. So here the current economic climate has evaluated a variety of the risk factor within the credit to cash process, and the need for the key commodity needed to deal with these challenges. That is your, you can say that what are those challenges? That is control, consistency, and the time. Okay, so expanding the automation of the credit to cash risk management can create a range of sizable benefit that will help the finance leader to make a faster credit decision that acquire a higher quality customer, better managed portfolio, and the payment that ultimately strengthen the company financial health. So SaaS help you to increase the efficiency and the transparency while reducing the model risk. Okay, and SaaS provide a well-defined automated governance and workflow solution. Now, second, we have the powerful and scalable analytics capability. Okay, so here the SaaS give you the unique ability to quickly develop and implement your own model with the power to analyze the large credit portfolio down to the individual loan assessment. So with the help of the SaaS, right, you get a modernized analytic foundation that scale the flexibility to address both current and the future requirement. So financial risk analytics provide a product and you can say the solution to the financial institution to measure and manage their counterparty credit risk, market risk, regulatory risk, capital, and the derivative valuation adjustment. Okay. The third, we have the customizable, adaptable data and reporting. So whether you are the specialized lender or the diverse multinational financial institution, our flexible framework gives you the ability to integrate and the stage high quality data and get the transparency needed for the full range of on-demand reporting to address the current and the future requirement. So our flexible data design accommodate the model that is developed using the SAS, okay, that is your industry standard or you can say open source software, okay. So here the strong risk management system can do more than just mitigate economic risk, that it confer a competitive advantage to the commercial bank and the private lender by improving their decision making. So implementing a credit risk management strategy can result in increased financial security for the lender and provide the borrower with the loan they can handle to build their credit. So when a borrower applies for a loan, the lender must evaluate their reliability to make the future monthly payment. So, beyond the request for the information on the borrower current financial situation and the income, many lenders will also want to see their borrowing and payment history. The fourth, we have the powerful modeling environment. So here the credit risk evaluation help you to develop the model using the SAS code. Okay, SAS code. So you can develop the model using the SAS, right? You can also develop the model using the Python and the R language. Okay, as well as you can also use the AI and the machine learning model also. So only SAS enable you to build and own the IP of the model that you develop, which help you to enable to address your unique business requirement. Fine. So a number of the world's largest banks have developed the sophisticated systems in an attempt to the model the credit risk arising from the important aspect of their business line. So and such models are intended to aid a bank in quantifying, aggregating, and managing the risk across the geographical and product line. Okay, and the output of this model also play a important role in the bank risk management and the performance of the performance measurement process that include the performance-based compensation, customer profitability analysis, and the risk-based pricing to a lesser degree active portfolio management and the capital structure decision. Okay, so here the task force, right, recognize the credit risk modeling may indeed to improve result in the better internal risk management that may have the potential to be used in the supervisory oversight of the banking organization. Okay, so before the portfolio modeling approach could be used in the formal process of the setting regulatory capital requirement of for the credit risk. Here the regulator would have to be confident not only that the model are being used to actively manage the risk, but also that they are conceptually found, empirically validated, and produce a capital requirement that are not comparable across the institution. Okay, so this is all about the how the SAS support the credit risk management. Fine. Next, what are the challenges for the bank? Okay, before the SAS, right? What were the challenge when the SAS come? What the challenges? Okay, let us see. So, right, SAS help you to reduce a case alert volume by the 40%, and it improve our fraud detection rate by the 35%, and reduce the false positive by the 18%. So, but with the fewer false positive and the predictive scoring model of the SAS, we can provide a better customer experience while detecting the fraud. Okay. So first challenges that come is IFRS 9 compliance. Okay. What is the IFRS means? The meaning of IFRS is the Financial International International Financial Reporting Standard. Reporting Standard. IFRS means International Financial Reporting Standard. Okay. So this IFRS, right? That is IFRS 9. Okay. It created a additional work and the complexity for the bank, which require the provision model that are unbiased and the forward-looking for all the financial assets that are not fair valued through the profit or loss. Okay. So one of the largest multinational banks in the world came to the SAS to develop a comprehensive strategic solution to build, deploy, and manage more than 200 models to comply with IFRS IFRS 9 regulation and put a reporting mechanism in place to handle the huge amount of data across a global operation. Okay, then what they did, so here the bank began the implementing an analytic platform from the SAS to support the deployment of the model that were being built in parallel. So while the deployment of the SAS model and the launch of the bank IFRS 9 program were complex. So they require a source data from the 60 to 20 system and the model which covering all the bank financial risk within the 2 months of the bank that had already begun implementing the model and component on the SAS platform. Okay, so within the 3 month, right, the bank had put in place an agile implementation process for the delivery of the new model every 2 weeks with the SAS providing support in the configuration. So what was the result? What was the result for this when they are using the SAS? So the result was like that. Here the bank gained a centralized, flexible, and the high-performance environment to meet the challenge of the expected loss modeling while advancing the risk management and financial reporting. Here, here, when they use the SAS, right? So 70% of the more efficient model deployment are in the support of IFRS 9 and the 60% more efficient model maintenance and management. Okay. So SAS helped the 60% more efficient model maintenance and management also. The second we have the what second challenge is it's come during the digital transformation. So like many banks, right? There is one Canadian bank, okay, you can say Canadian financial institution wanted to inform wanted to transform, not inform, wanted to transform into the digital organization, okay, to not only build a new channel to reach to the customer, but to also to communicate with the customer in their preferred channel, okay. So what they did, so they partnered that bank, the Canadian financial institution, okay, Canadian financial institution They partner with the SAS to create a unified and agile end-to-end data science platform deployed in the cloud so that the new capability could easily be added. So by moving to a data lake, the organization minimized the cost and the inefficient data movement and replication. The so what is the result of this? What is the result of second one when the digital transformation were done using the SAS? The result is like that when the SAS are used, so they are powered with the modernized and agile SaaS via infrastructure in the Google Cloud. And this financial institution can quickly model and analyze the big data to improve the customer experience and produce the business value. SAS with the memory and with the database processing, they have cut the processing time a half. And here all the user, regardless of the coding language preferences, can visualize the analytics also. Okay, and the bank had transformed into a digital enterprises that provide a top-notch, consistent customer experience across the channel. The third challenge is it comes during the accurate risk scoring and analysis. Okay, so this is the third challenge, okay, for the bank. So here the three regional banks in the Europe were in the danger of being downgraded by the regulator and the rating company because they lacked a sound credit risk management process. Okay, so they each struggle with the lengthy time to market when changing scoring model. So here the analytical life cycle process for credit score model took more than a year in practicing the risk of the portfolio. In addition to that, the data gathering, analytics, and the reporting process were very manual, which reduced the bank control of the portfolio. So what they did, so here the bank implemented the SAS solution to speed the time to market for the scoring model and also helped to create a sound credit management process and trace the changes in that process. Okay, so what were the result? So result were here. So it so here it helped to pre-build the data management process that helped the bank to achieve a shorter time to market for the credit risk model and the more accurate risk score of the customer. It also helped to improve the credit risk management and the more accurate risk score for the customer and the flexible pricing that improved the bank ability to introduce the new product quickly. The third is your reducing the operating surge. And sorry. So third, you can say like that here. It increased the when it is integrated with the SAS. So it increased the accuracy and the consistency of the credit risk analysis using the enhanced data that help to benefit each bank bottom line. Okay. Now coming to the fourth one, fourth challenge is it reduced the operating cost and increasing the efficiency. Okay, so with the profit margin sinking, right, so the global bank needed to find the new revenue opportunity and reduce its operating cost by the 5 billion over the next 24 months. So, because of the poorly performing data and the analytic infrastructure, the business was unable to respond quickly to new opportunity and regulatory requirement. So, what they did to reduce the operating cost and increasing the efficiency. So, here the bank used the SAS solution to migrate from its old decentralized legacy system to the new modernized hub and providing the bank with the big data analytic capability as a shared service across its worldwide organization. And within the new shared service platform, they implemented the reporting and the dashboard for the multiple projects such as you can say international revenue, customer lifetime value, customer complaint, collection reporting, credit and credit risk. And and when they used SAS, the result were drastic that reduce the onboarding time of the new analytic use cases, and it also helped to save more than $125 million by consolidating the IT infrastructure to a new open service environment. It also helped to improve the analyst efficiency by the 30 to 40%. And it helped to SAS helped to influence the net new revenue of your 1 billion. Okay. Now, okay. So, what is the advantage of SAS? If what is the advantage of SAS? So, SAS is your easy to learn. Okay. So SAS is easy to learn. So SAS is very easy to learn the syntax, and it can be learned easily without any programming skill. Okay, so that anyone can learn it. So coding of the SAS is your simple English language, or you can say statement, which we use it in the day-to-day activity. The second one, it is easily able to handle the large database. So SAS is strongly capable of handling the large database very easily. Now, easy to debug. Okay, SAS is very comprehensive language, right? And the process of debugging is very easy here. And it is easy to understand and correct the error because in the log window it is stated clearly. Now it SAS have the tested algorithm. Okay, so here the algorithm implemented in the SAS program is fully tested and analyzed by the developer, and every version of the SAS is tested in a controlled environment before it released. So testing is possible because the SAS is the closed source language. So you know that if any language is the closed source, you are not able to modify its source code. Okay. Now, fifth one is SAS provide you the customer support also. So here the organization of the SAS maintain the proper monitoring, as it is like a complete organization to analyze the SAS, and it also support the customer support, right? And the SAS customer support handle all kinds of the problem. Now, coming to the data security, okay. So SAS is a primary tool for the large scale company, and the company data is confidential here. That's why it is a closed source of company, and the data of the SAS is completely secure. And in case of the office use, right, without the license we cannot extract the data. Even the manipulation is not possible without the license because of the data security. Okay, so this is the reason behind its popularity in the corporate world. Now, the last one we have the SAS GUI, that is graphical user interface. So SAS is a language that made the statistical computing easier for the non-programming user. Okay, and it has an amazing GUI, that is graphical user interface, and here it user interface has various tools like plot. They can plot the graph, okay, and it is having the highly versatile library. Okay, so this is all about the today's session. Okay, now, so these are the three branches of Sankhyana Consultancy Service. So the head office of Sankhyana Consultancy Service is Kamnahalli, Bangalore. Okay, and this is the contact number. Sankhyana Consultancy Service having the two branches office also. So one is in the Bangalore, and the another branch office is in the Delhi Onson Rohtas. And these are the contact number. If you have any technical query, right? So you can ask me. If you can also contact at this number for any non-technical query also. So this is all about, and those who have not filled the form, okay, I'm sending you the link in the chat box. Okay, please fill that form, those who have not filled. And thank you everyone for joining this session.